So what is active investment management and what's an active investor? Effectively, what an active investor does is they attempt to beat an index or to target performance by analyzing the range of shares available. They try and pick which shares they think will perform better relative to other ones. So they're trying to pick the most promising shares and generate as much profits as possible by picking those shares that go up the most. That's the core goal. The goal is to pick the shares that will go up or will appreciate in price or in value the most and exclude other shares. Now, at an institutional level, a lot of this active investment is done frequently by way of funds, what we call mutual funds, or via vehicles for retail investors called unit trusts. And what the asset managers will do is they will charge a fee to select the best performing shares within a particular market. For instance, the Johannesburg Stock Exchange, the Nairobi Stock Exchange, or the Nigerian Stock Exchange. Now, the intended benefits of active investment management is that by giving the asset manager a specific mandate, you're laying out the objectives and their strategy, and you're dictating what risks and hopefully what the anticipated returns that are going to be generated by that asset manager. Now, obviously, the asset manager will charge a fee because they are professionals and they market their services on the basis that they're professionals, and they will allocate and choose the correct shares in accordance with the mandate that the fund has agreed upon. So the idea is that because they're an investment professional as the asset manager, they are going to outperform. They're going to generate better returns for you than you would generate if you were investing the money yourself. In addition, implicit in that is that they would generate better returns than if you were invested in an index fund. And an index fund is something that simply tracks the exchange. It simply tracks the exchange. It's very, very simple. But you can take a look at that when we look at index funds in a later part of this module. Now, here's a Mac truth you must hold on to, and it's a warning with regards to active asset managers. Most active asset managers have been shown to fail to beat the index or the benchmark that they are aiming for. What do I mean by that? If the Johannesburg Stock Exchange goes up by 15% in any given year, the asset managers who are actively managing your funds, most of them don't beat that 15%. Actually, 80 to 90% of actively managed funds fail to outperform or beat the benchmark index. Having said that, they charge much higher fees than an index fund would. So most people, when they invest in active asset managers, are actually worse off because they're paying much higher fees. But a lot of these active asset managers are not meeting the mandate or the benchmark on which their performance is ranked against. 90% of them are not. So you're actually most likely to be worse off with active asset managers.